The S&P 500 has returned an average of 10% per year over the past century, with some years seeing gains as high as 30% and losses as deep as 40%. Yet the overall trend remains stubbornly upward. This phenomenon has led many to wonder what drives the stock market's inexorable rise, particularly during times of economic turmoil or global uncertainty. The answer lies not in any single event or economic indicator, but in the complex interplay of historical trends, technological advancements, and human psychology that have shaped the global economy over the past century. The consequences of this long-term uptrend are felt by millions of people around the world. From the retirees in the United States who rely on their 401k investments to fund their golden years, to the factory workers in China who toil on assembly lines producing goods for multinational corporations listed on the New York Stock Exchange. In Japan, the Nikkei 225 index has seen periods of explosive growth, only to be followed by decades of stagnation, leaving many investors reeling. Meanwhile, in Europe, the economic integration of the continent has created a vast, interconnected web of financial relationships, with the fate of the Eurozone hanging precariously in the balance. To understand why the stock market always seems to go up in the long run, it's essential to look at the historical context. The 20th century saw the rise of the United States as a global superpower, with the dollar emerging as the world's reserve currency. This led to a period of unprecedented economic growth, as American corporations expanded their reach across the globe, driven by technological innovations and the emergence of new industries. The creation of the Federal Reserve in 1913 and the subsequent development of monetary policy tools allowed policymakers to mitigate the effects of economic downturns, providing a safety net for investors. The post-World War II period saw the establishment of the Bretton Woods system, which fixed exchange rates and provided a framework for international trade, further fueling global economic growth. The 1980s saw a significant shift in the global economic landscape, as the rise of neoliberalism and the deregulation of financial markets led to an explosion of new financial instruments and trading strategies. This period also saw the emergence of the Asian tiger economies, as countries such as South Korea and Taiwan underwent rapid industrialization and became major players in the global economy. The 1990s and 2000s saw the dawn of the Internet age, with the emergence of e-commerce and the proliferation of digital technologies that transformed the way businesses operate and investors interact with the market. One of the key factors driving the long-term uptrend in the stock market is the power of compounding, where small, consistent gains over time can add up to significant returns. This is particularly evident in the case of dividend-paying stocks, where investors can reap the benefits of regular payouts and reinvest them to generate even greater returns. The emergence of index funds and exchange-traded funds, ETFs, has also made it easier for individual investors to participate in the market, providing a low-cost and efficient way to gain exposure to a broad range of assets. Another crucial factor is the role of human psychology in driving market trends. Investors are often subject to cognitive biases and emotional influences that can lead to irrational decision-making, such as the fear of missing out, FOMO, or the temptation to buy into a hot stock. However, over the long term, these biases tend to cancel out, as investors who take a disciplined and patient approach to the market are often rewarded with superior returns. The importance of diversification and risk management also cannot be overstated, as investors who spread their assets across different asset classes and geographic regions can reduce their exposure to volatility and increase their chances of achieving their long-term goals. As we look to the future, it's clear that the stock market will continue to play a vital role in shaping the global economy. The rise of emerging markets, such as China and India, is likely to create new opportunities for investors, while the growth of sustainable investing and environmental, social, and governance (ESG) considerations will increasingly influence the way companies operate and investors allocate their capital. The ongoing digital transformation of the financial sector, driven by technologies such as blockchain and artificial intelligence, will also continue to reshape the landscape of the stock market, creating new possibilities for efficiency, transparency, and accessibility. In the end, the stock market's long-term uptrend is a testament to the power of human ingenuity, and the enduring appeal of investing in the global economy. As investors, we would do well to remember that the market is a reflection of our collective hopes and fears, and that by taking a patient, disciplined, and informed approach, we can harness its energy to achieve our financial goals and build a brighter future for ourselves and our communities. The next time you hear someone say that the stock market is a casino, remember that the house always wins in the long run, but only if you're willing to play the game with a clear head and a steady hand. The real question is, will you be along for the ride?